Financial news and market reports create a world defined by motion. We see shouting traders, flashing tickers, and a frantic race to react to data. This environment conditions the public to treat every market fluctuation as a crisis that requires an immediate response. If the market drops, investors are told to take cover. If it surges, they are told they are falling behind. This creates a pervasive assumption. To grow wealth, you must outsmart the crowd by anticipating trends, rotating sectors, and constantly buying and selling with precision. Yet, despite the billions of dollars spent on trading algorithms and professional management, the historical data presents a striking contradiction. The most effective path to wealth appears to involve a total departure from this constant motion. In 1984, portfolio manager Robert Kirby noticed a peculiar pattern while reviewing his firm's client accounts. He eventually codified his findings into a strategy he called the coffee can portfolio. The concept relied on a physical metaphor. An investor would select a diverse set of high-quality companies, place the physical certificates inside a literal coffee can, and leave that can on a shelf for a decade. Kirby found that untouched portfolios, often because the owner had died or simply forgotten the shares, frequently gained more value than the actively managed funds run by his firm's professionals. The coffee can study demonstrated that a total lack of intervention could produce better long-term returns than the industry's most aggressive experts. This occurs because active trading carries a heavy mathematical penalty known as friction. Every transaction generates brokerage fees and triggers capital gains taxes, which slowly bleed a portfolio's total value over time. There is also a psychological cost. Human biology makes it difficult to sit still during volatility, leading many to panic sell at the exact bottom of a crash or buy during the height of the speculative bubble. Professional fund managers face these same pressures. To justify their management fees, they often feel compelled to shuffle investments around, even when the data suggests the correct move is to do nothing. Frequent trading acts as a voluntary tax on impatience. It effectively transfers wealth from those who react to those who wait. So, what happens inside a portfolio when it is left alone? Financial analyst Christopher Mayer identifies two specific forces that drive this growth, which he calls the twin engines. The first engine is a high return on equity, or ROE. This measures a business's ability to generate significant profits using the money it already has, rather than relying on external debt. The second engine is a long growth runway. This is the amount of time a company has to continuously reinvest those high internal profits back into its own operations. This graph shows the result when these two engines run uninterrupted for decades. The growth starts off slow and linear, but as profits are reinvested year after year, the math creates a dramatic hockey stick trajectory. Wealth accumulates when the internal math of a great business is allowed to reach its conclusion over several decades. Behind the scenes, an automated mechanism called a dividend reinvestment plan, or DRIP, can accelerate this process further. In this system, cash dividends are automatically used to buy fractional shares. Each subsequent dividend is calculated on this expanded base of shares. With every cycle, the investor owns a slightly larger portion, generating an even larger dividend next time. Over 20 years, this silent, automated reinvestment loop often accounts for the majority of an investor's total return, provided they never interrupt the cycle. The ultimate target for this strategy is the 100 bagger, a stock that returns 100 times the initial investment. Market history reveals a difficult requirement for these gains. The average 100 bagger takes exactly 26 years to reach that milestone. Those 26 years are rarely smooth. The most successful companies in history suffer multiple periods where the stock price drops by 30 or 50%. Over a quarter century, investors face massive historical shocks, wars, energy crises, and political instability, creating an intense urge to sell and abandon the strategy. The few investors who captured these 100-fold gains shared a single trait. They maintained their positions during these periods of extreme market volatility. In 1972, analyst Thomas Phelps argued that wealth requires the vision to identify a great company, the courage to buy it, and the extreme patience to hold it. The coffee cam strategy works because it is psychologically excruciating. It acts as the ultimate filter, rewarding only those who can endure the math of compounding over the deafening noise of the present.